Everything looks fine. Markets are printing new record highs. Corporate earnings are beating analyst estimates quarter after quarter. Consumer confidence surveys are reporting levels not seen in over a decade. Every anchor on every major financial network is delivering the same message. The fundamentals are solid, the economy is resilient, and the bull market has further to run. This is exactly what the financial landscape looked like in 2007, and in 1999, and in 1987. Michael Burry does not watch financial news. He reads the filings. He reads the prospectuses. He reads the footnotes that no television segment has time to cover and no anchor has the patience to explain. And what Burry is reading right now is not telling the same story as the headlines. Today, we examine what the documents say versus what the narrative says. The gap between those two things is where the next crisis lives. And according to Burry's framework, that gap has never been wider. Michael Burry is not a product of Wall Street. He is a former medical doctor who built his investment career in near-total isolation, reading financial documents with the obsessive precision he once applied to medical literature. Burry founded Scion Capital in 2001, operating from a single office in Cupertino, California. Before he became globally known as the man who predicted and profited from the 2008 housing collapse, documented in the film The Big Short, Burry had already built a track record of identifying mispriced risk that the financial establishment had overlooked or chosen to ignore. His returns during the 2001 through 2002 bear market were strongly positive, when virtually every other fund was bleeding. When Burry speaks about market cycles and the mechanisms that lead to crashes, he speaks as someone who has read the underlying documents, modeled the numbers independently, and arrived at conclusions the consensus dismissed until the moment it could not. To understand Burry's framework for crash cycles, we first need to understand what he believes drives them at the deepest mechanical level. Burry's analysis consistently traces every major cycle back to one root cause: liquidity. Specifically, excess liquidity injected into a financial system that lacks the productive capacity to absorb it without generating dangerous speculation. When central banks suppress interest rates and hold them near zero for extended periods, money becomes cheap. Cheap money flows into assets. Rising asset prices generate confidence. Growing confidence expands risk tolerance. Expanding risk tolerance increases leverage. More borrowed money chases the same assets, pushing prices progressively further from any reasonable measure of underlying value. Burry has described this sequence across multiple public communications over more than 2 decades. What makes his framework distinct is not the identification of the cycle itself, which financial historians have documented for generations, but the structural analysis of the amplifiers that make each successive cycle more dangerous than the one that preceded it. Burry's central thesis about crash cycles centers on what he identifies as the reflexivity loop in asset markets. The concept of reflexivity, originally developed by investor George Soros, describes a feedback mechanism in which market prices influence the very fundamentals they are supposed to reflect. In Burry's application, the reflexivity loop operates as follows. Rising prices attract additional capital. Additional capital drives prices higher. Higher prices generate a narrative of value creation and economic strength. That narrative draws in participants who would otherwise not be in the market at all, including retail investors, pension funds chasing benchmarks, and institutional capital following relative performance pressure. Each new wave of participants brings fresh capital that sustains and accelerates the price rise. Concentration builds in the assets that have performed best. The distance between price and underlying value widens continuously until even a modest disruption to the inflow of new capital triggers a violent repricing. Burry has consistently argued that this loop, once fully engaged, does not unwind gradually. It unwinds in the way all structural failures do. Suddenly, completely, and with a severity that surprises everyone who normalized the conditions that built it. Burry's reading of financial history identifies 4 recurring phases inside every major crash cycle. The first is the liquidity injection phase. A central bank or fiscal authority floods the system with cheap capital, typically as a direct response to a prior contraction. Interest rates fall, credit spreads compress, asset purchases by both institutional and retail investors accelerate. Early participants generate strong returns, and the prevailing narrative shifts toward one of recovery, growth, and abundant opportunity. In this phase, the data that will eventually define the crisis is already forming in documents that almost no one is reading. The seeds of the next collapse are planted in the same moment the last one is being declared over. The second phase is the speculation cascade. As asset prices appreciate, the returns attract participants who are progressively less focused on underlying value and more focused on price momentum. Leverage enters the system at scale as investors borrow against rising assets to amplify returns. Financial products are engineered to package and redistribute risk in ways that obscure its true nature from the ultimate buyers. Burry pointed to this dynamic with specific precision in his analysis of the mortgage market between 2003 and 2006. The prospectuses of mortgage-backed securities during that period contained explicit disclosures of deteriorating loan quality, rising loan-to-value ratios, and deeply aggressive underwriting standards. The information was present. It was public. It was in the documents. And almost nobody in the financial system was reading the documents. The third phase is concentration. Capital does not distribute evenly across assets during a speculative cycle. It flows with increasing intensity toward whatever has performed best in the recent past. In equity markets, this produces the dynamic Burry has analyzed in precise detail. A small number of companies absorb a disproportionate share of total market capital, their prices rising, not because of fundamental improvements to their actual businesses, but because of the mechanical weight of continuous capital inflow. According to Burry's analysis, this concentration creates a structural fragility that the majority of market participants fail to model. When the inflow of new capital slows or reverses, the most concentrated assets face the most severe and rapid repricing. The apparent safety of owning the largest and most widely held names in the market transforms into a liquidity trap. The exit is dramatically narrower than the entry was. Burry made this argument explicitly in 2019 when he published his analysis of the concentration risk embedded in passive index funds and the top-heavy structure of major market indices. The fourth phase is narrative capture. Burry identifies this as the most dangerous stage of the cycle, not because of what it reveals about the market mechanics, but because of what it reveals about the psychology of the people operating within it. In the narrative capture phase, skepticism becomes professionally and socially costly. Analysts who raise structural concerns are dismissed as perma-bears or chronic pessimists. Institutions that reduce risk exposure underperform peers and face client redemption pressure. The financial media dedicates the overwhelming majority of its coverage to continued upside. And the analysis of those who disagree is treated as fringe noise rather than serious investigation. Burry has described this phenomenon as one of the most reliable late-stage indicators he monitors. Not because dissent itself is a market timing signal, but because the systematic suppression of dissent signals that price discovery has effectively broken down. The market is no longer processing information about risk. It is running entirely on narrative momentum. And narrative momentum, by definition, cannot be sustained indefinitely. Burry has argued that identifying the precise trigger of a crash is a distraction from the more important analytical question. The relevant question is not what will cause the reversal. The relevant question is why the system has become structurally vulnerable to any trigger at all. In 2008, the trigger was rising default rates in subprime mortgages. Burry has repeatedly emphasized that the trigger could have been almost anything. The housing sector was simply the first load-bearing wall to crack. The real cause of the catastrophe was the accumulated leverage, the concentration, the deteriorated underwriting standards, and the narrative capture that had compounded across years. Once confidence broke at any single point in the system, the reflexivity loop reversed direction with the same mechanical force it had operated with on the way up. Falling prices triggered margin calls. Margin calls produced forced selling. Forced selling drove prices further down. Lower prices generated broader fear. Fear produced more selling. In a leveraged and concentrated system, this cascade moves faster than any institution can respond to or contain. Running beneath every phase of Burry's cycle framework is the variable he returns to most consistently: debt. In a deleveraged market, a repricing of assets causes pain but remains containable. In a market where debt has accumulated at every level of the economy, a repricing triggers a chain of margin calls, covenant violations, and forced liquidations that transform a standard correction into a systemic crisis. Burry has pointed to current global debt levels as a structural feature that distinguishes the present environment from prior cycles. Total global debt stands at levels without peacetime precedent. The debt service burden of major governments consumes an increasing share of public revenue with every passing quarter. Corporate debt issued at historically low rates during the quantitative easing era now faces refinancing in a structurally higher rate environment. Each of these dynamics acts as an accelerant the moment the reflexivity loop begins to run in reverse. The system does not need a large shock to break. It needs only a disruption large enough to interrupt the flow of new capital that has been masking the underlying structural damage. Applying Burry's framework to practical investor behavior begins with the practice that defines his entire career: reading the primary source, not the summary, not the analyst note, not the financial media interpretation of the analyst note, the actual document, the filing, the prospectus, the footnote on page 47 that nobody read before signing. Whatever you hold in your portfolio today, Burry's analytical standard demands a single honest question. Have you actually read the document that governs what happens to your money when the consensus breaks? The second practice Burry embodies is stress testing the exit rather than the entry. The entry question is almost never the important one. The question is, what happens when every other holder of that same investment decides to exit at precisely the same moment? In concentrated indices and passive vehicles holding underlying assets with limited daily liquidity, that stress test produces answers that most investors have never seriously confronted. The third practice is the most difficult to maintain: independent judgment at the exact moment when social and professional pressure to conform is at its highest. Burry's advantage was not superior intelligence. It was that he was reading documents when everyone else was watching the narrative, and that he was willing to act on what the documents showed, even when every institutional structure around him insisted his analysis was wrong. Today, we examined Michael Burry's framework for the market cycle that precedes a crash. We traced the 4 phases he identifies in every major speculative episode: liquidity injection, speculation cascade, concentration, and narrative capture. We examined the reflexivity loop that accelerates both the inflation and the collapse of market bubbles. And we analyzed the debt variable that Burry identifies as the amplifier that transforms ordinary corrections into systemic events. Burry's work is a consistent reminder that every phase of the speculative cycle feels rational and even inevitable from inside it. The data that contradicts the narrative is present in the documents for anyone willing to read it. The question his framework leaves with every serious investor is not whether the next crash is coming. Cycles end. They have always ended. The question is whether you have built the analytical habits his framework demands, reading the primary sources, stress testing the exits, and preserving the capacity to act on your own analysis when the cost of doing so is highest. According to Burry's philosophy, that preparation is not optional. It is the only real defense against the cycle's next turn. Thank you for watching.